The stock market is currently closed, with the latest closing session recorded on July 29, 2026, where SoFi Technologies stock closed at $15.25. That represented a sharp single-day sell-off of nearly 8.9% on massive trading volume exceeding 193 million shares. For context, that sell-off dragged the equity down to a fresh 52-week low of $14.88 during intraday trading, before settling slightly above that floor. Now, if you are looking purely at the surface headlines, this sudden drop looks like a classic catastrophe following an earnings announcement. Standard financial media outlets immediately jumped on the narrative that investors were fleeing due to fear over loan quality, credit risk, and potential valuation inflation. But if you take a closer look at the actual mechanics behind this price action, the real story tells a completely different tale. While the retail crowd was frantically hitting the sell button after seeing a red screen, institutional capital was quietly executing an intricate reallocation strategy. The market narrative told you that SoFi failed, but the actual reported numbers proved that revenue hit a record $1.21 billion for the quarter, beating consensus estimates by $80 million. Non-GAAP earnings per share came in at 12 cents, beating expectations once again. Management even raised full-year revenue guidance to between $4.75 and $4.85 billion, while confirming target growth for SoFi Plus members. So why on earth did the stock plunge nearly 9% on record-breaking volume? The expectation was that strong fundamental beats would spark a massive rally toward $20 per share. The reality, however, is that Wall Street had priced in absolute perfection and was looking for any minor excuse to take profits and force out over-leveraged retail positions. The market reacted not to a failure in core execution, but to a temporary structural reset in how the platform balances its lending originations versus its technology platform fees. When mainstream commentary focuses exclusively on headline top-line numbers without evaluating net interest margin sustainability or capital reserves, retail investors panic. That disconnect between market sentiment and fundamental realities is precisely where the greatest mispricings occur. Wall Street loves to treat SoFi Technologies as nothing more than a volatile regional bank whenever interest rate expectations shift, yet they price it like a hyper-growth tech firm when enthusiasm spikes. The general consensus among retail traders has long been that as long as member growth keeps climbing, the equity should naturally follow a continuous upward trajectory. But that line of thinking ignores how institutional algorithms evaluate risk-weighted assets and balance sheet leverage. When you look at broad platform adoption across the market, whether traders are executing orders on Tesla stock, Apple stock, or Nvidia stock, institutional desks always use earnings volatility as liquidity events. When retail traders rush to cover margin requirements or dump shares out of fear, institutional algorithms step in to collect discounted equity. This behavior is clearly visible when examining order flow across major investment brokerages. Platforms like SoFi Active Investing, SoFi Robo-Advisor Systems, SoFi ETFs, and general SoFi investing tools are capturing an increasing share of user deposits, yet the stock price frequently behaves as if the underlying platform were losing market share. To truly understand this dynamic, we must look at what this business actually does beyond the ticker symbol. SoFi Technologies began its life as social finance, focusing primarily on student loan refinancing for high-earning, credit-healthy graduates. Over time, the company aggressively expanded its product suite to become a comprehensive financial super app. Today, its operations span three main segments: lending, financial services, and the tech platform. The lending segment generates interest income and origination fees from personal loans, student loans, and residential mortgages. The financial services segment encompasses checking and savings accounts, investment products, credit cards, and cash management solutions. Meanwhile, its tech platform segment, powered by Galileo and Technisys, provides core banking infrastructure and payment processing capabilities to other financial institutions globally. This multi-pronged structure is precisely why comparing SoFi Technologies directly to traditional banking institutions misses the point. When individuals manage wealth through Fidelity investments, Fidelity brokerage accounts, Fidelity ETFs, Fidelity mutual funds, Fidelity wealth management, Fidelity IRAs, or the Fidelity mobile app, they are utilizing legacy financial infrastructure. Similarly, users engaging with Schwab Intelligent Portfolios, intelligent portfolio algorithms, online investing tools, online investing portals, investment help services, self-investing, or options to invest online are operating within classic asset management frameworks. SoFi, by contrast, attempts to capture the entire customer lifecycle from initial student debt to active stock trading, credit, and savings inside a single ecosystem. However, past financial reports show why Wall Street remains hesitant to grant the company a full software-style valuation multiple. During the period of aggressive federal interest rate hikes, student loan refinancing activity slowed dramatically, forcing the business to pivot heavily toward personal loan originations. While personal loans generated substantial fee income at high yield, they also brought increased investor scrutiny regarding potential default risks during economic slowdowns. Although past quarters demonstrated that the company could consistently acquire members at scale while maintaining controlled charge-off rates, skeptics pointed to the growing total loans held on the balance sheet as a potential vulnerability if credit conditions were to weaken rapidly. This brings us right back to our expectation versus reality frame. The market expected that achieving sustained profitability would instantly clear the path for a permanent rally toward historical highs. The reality is that once a fintech platform transitions to a fully chartered bank, it becomes subject to bank-like regulatory capital requirements and valuation metrics. Earnings quality matters far more than raw user acquisition numbers. Investors want to see that fee-based, capital-light revenue from the Galileo and Technisys tech platforms grows faster than interest income derived from holding loans on the balance sheet. When tech platform revenue growth appears moderate compared to lending volume, institutional analysts lower their forward earnings multiples even if overall net income beats expectations. Take a second right now to share your perspective in the comments section below. Comment below how many shares of SoFi stock you currently hold in your portfolio and whether you are buying this drop or waiting for further confirmation. Looking ahead toward future scenarios, several critical catalysts and risks will determine where this equity trades over the coming quarters. The first major catalyst is the continued expansion of fee-generating products that require zero balance sheet risk. If the technology segment can secure larger enterprise clients and expand international processing volume, market perception will shift from viewing SoFi as a high-growth bank back to viewing it as a scalable software technology provider. Such a shift could trigger a significant expansion in its price-to-earnings and price-to-sales multiples. The second critical driver is the macroeconomic interest rate environment. Lower benchmark interest rates typically reduce funding costs for deposit-taking institutions while simultaneously reviving demand for student loan refinancing and personal credit. If net interest margins remain resilient as loan originations pick up, profitability could accelerate faster than current Wall Street consensus estimates suggest. Conversely, the principal risk remains credit performance. If macroeconomic conditions weaken and consumer default rates rise unexpectedly, the company may be forced to increase its loan loss provisions, directly impacting bottom-line profitability and dragging valuation multiples lower. Another factor to monitor is competitive pressure within the online brokerage and active trading space, as platforms like SoFi Invest continue competing directly for retail market share against established entities like SoFi Trading Platform, Robinhood Stock Trading, and traditional self-investing platforms. Retail traders enter and exit positions based on momentum, whereas large institutional funds trade on structural valuation gaps. In summary, the recent dramatic price swing down to $15.25 after hitting a 52-week low of $14.88 highlights the stark contrast between market expectations and fundamental realities. The market expected flawless forward metrics and panicked at the first sign of complex balance sheet adjustments, driving massive volume and heavy intraday volatility. Yet the underlying reality reveals a profitable, growing ecosystem delivering record quarterly revenues, expanding member counts, and raised full-year guidance. The short-term price action reflects institutional liquidity harvesting rather than an operational breakdown. Investors who look past headline reactions to examine structural earnings quality, capital efficiency, and platform expansion will be far better positioned to navigate the ongoing volatility surrounding this equity.